The silver gold spread will shift. In fact, you've seen that anytime you see a surge that lasts, let's say, a month or so in the monetary metals, generally silver will beat gold. And similarly, when gold pauses or pulls back a little bit, silver will beat gold to the downside. So it's a wild child. Both those metals are poised for out of incremental bull trend into something that chaos theory people would enjoy. Rapid ascent. Break all the models of how you've behaved for the last few years and start to go vertical. And I think that probably will be partly an effect of asset managers saying, I knew this thing would break. I'm getting out of the stock market to some extent, and I'm moving that money somewhere else. And one of the good areas to me looks like gold because it's behaving well and the miners are undervalued. And I think that's where you'll get the goose in the monetary metals. It's just the anticipation of the stock market wobbling.
Precious metals have been taking advantage of the recent pullback in the U.S. dollar. Gold has advanced 1.7% in the last 4 sessions, while silver rose over 7% before pulling back on Monday. Both had struggled to attract buyers over the past few weeks as stronger economic data in the U.S. led markets to reprice their expectations about rate cuts from the Federal Reserve. This pushed the dollar to 3-month highs, but it also helped yields recover some ground, which weighed on precious metals and increased the opportunity cost of holding them as they are non-yielding assets. However, as gold is more expensive, momentum analyst Michael Oliver asserts that historically, during surges in monetary metals, particularly silver, tends to outperform gold. Conversely, silver maintains strength relative to gold during periods of gold's pause or slight pullback. As a result of an increased industrial offtake, silver prices are expected to hit a new high level in a decade, reaching almost $30 per ounce, according to research released on January 30th by the Silver Institute. Even though gold has made back most of its losses from the previous week, it remains bang in the middle of a trading range the metal has been stuck at since hitting a record high in December. For now, the gold chart has broken the first line of resistance at $2,015, which is a potentially bullish signal. Despite that, we will still need to see further bullish price action before dropping our short-term bias on gold. Michael views gold as behaving well and miners as undervalued, suggesting a favorable outlook for the precious metals market amidst anticipation of stock market instability. Yet, he suggests that gold's bullish trend may hinge on surpassing $2,100, while for silver, $25 signifies a potential rapid ascent challenging past trends. We will present clips from Michael Oliver's interview with Liberty and Finance. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you and enjoy the video.
The silver gold spread will shift. In fact, you've seen that anytime you see a surge that lasts, let's say, a month or so in the monetary metals, generally silver will beat gold. And similarly, when gold pauses or pulls back a little bit, silver will beat gold to the downside. So it's a wild child. And the same is true with the gold miners. You know, there have been points in time, especially that summer, the spring to summer 2020, when gold went up, 40%, and they went up triple, So they're slingshot type markets, silver and the miners especially now. And I think the biggest slingshot I've ever seen, possibly in my entire career, which goes back to the mid-'70s, is what the miners are set up for right now. And I think there's some big guys out there who may not be looking at charts like I am, momentum charts especially, but realize just on a fundamental basis that this is a place to be. Nobody wants it. I'll take it. While the stock market caves, if you think gold stocks go with the S&P, look at the chart the last 3 months. Total opposites, okay? So expect that to continue. Stock market goes down, those gold miners are going up because they're going to be grabbed by a lot of asset managers. Now, all we're looking for is the initial wobble. And I think gold will see that clearly. And as far as a number for gold, we know it got to 2150 back in December. Didn't stay there, but for a few hours. Buy stops being triggered, okay? And then there was a vacuum of buying underneath because you triggered all the buy stops. And since then, you've consolidated mostly above 2000. We had a brief dip in the 1980s in late December. And again, this past month, we dipped down to 1990 something. But basically, it's in the 2000s. If you get back over 2100 again, not back to the highs at 2150, just get back over 2100, we've got some metrics that say lid's coming off. And I don't think gold's going to wait for a whole lot of evidence from the stock market to say, okay, game on. It's going to look for the initial evidence because gold is an anticipatory market. It doesn't normally make its moves based on a hard piece of data, for example. You might see an hourly or daily action based on disappointment or happiness to do a data point. But the big trend structures in gold tend to break without any headlines in anticipation of likely headlines to come. Gold's a smart market. And I would say right now, you get back over 2,100 gold, you're gone. Silver back over 2,350 again is going to look good. Right now, we're just below 23. There's some big triggers on silver as well that say launch time. And by launch time, I mean where you go up in geometric fashion, like we did in the spring and summer of 2020. Silver went from under $20 to $30 in about 6 months. So percent-wise, I think the real liftoff point for silver is just above 25. And we get very specific in our reports. We update the numbers and if they change. But both those metals are poised for a shift out of incremental bull trend into something that chaos theory people would enjoy. Rapid ascent. Break all the models of how you've behaved for the last few years and start to go vertical. And I think that probably will be partly an effect of asset managers saying, I knew this thing would break. I'm getting out of the stock market to some extent, and I'm moving that money somewhere else. And one of the good areas to me looks like gold because it's behaving well and the miners are undervalued. And I think that's where you'll get the goose in the monetary metals. It's just the anticipation of the stock market wobbling.
Throughout 2023 and into early 2024, the U.S. dollar largely traded within a narrow range compared to major currencies like the euro. In late September 2022, the dollar index surged to a recent all-time high of 115, demonstrating significant strength. This marked a notable increase from its weaker position at the end of 2021, with a value of 96. However, by July 2023, it plummeted to below 105 before reaching a peak of over 107 in late October. By December 2023, the index dropped below 105 before rebounding in early 2024. Interestingly, despite bonds rallying and indicating lower yields, the dollar failed to reflect this upward rate movement fully. Even as bonds reached new price lows in October of the following year, the dollar index did not revert to its peak of 115. Instead, it hovered around 104, exhibiting signs of weakness. Michael highlights that if the dollar index closes the week below 104, it would break its weekly momentum, potentially indicating a downtrend. Furthermore, Michael notes that since December 2015, while the dollar index has only experienced a modest increase of about 5%, gold prices have more than doubled. This disparity suggests that while a weakening dollar may support gold prices, it is not the sole determinant of gold's performance. Let's get back to the interview.
The dollar index was at 115 back in late 2022. That was when the bond market made a low. I mean, yields were high, okay, and that helped promote the dollar, okay, relative to other currencies. So the dollar was at 115, dollar index. Now remember, the dollar index is about 70% comprised of the euro and the yen, okay? So it's really almost an inverse of the euro, which I think is like 56% or something of the dollar index. But then you collapse from the 2015 high in the dollar all the way down around the 100 level. I think 101 had been the low back then in early 2023. Well, at that same time, bonds rallied, so did gold. Okay. Now, bonds went down and made a new low in price October of this past year. So a year after that, October 22, new low. Now, if the dollar had fully reflected the rise in rates here, when bonds went down and took out the price low in 2023 of the 2022 low, the highest it ever saw in that rally last year was 107. Then it puked back down again toward 100 again. Right now, we had a rally up to 104. But right now, if we close the week out where we are now, below 104 on the dollar index, we're going to break its weekly momentum. Now, that's not a great, big, giant metric, but it's enough. We've been living above it for 9 or 10 weeks, similar to the stock market, which is very interesting. In other words, the dollar index has been more or less behaving like the stock market, living above certain moving averages, a happy bull, so to speak, but anemic for the dollar. And right now, this week, if you close where you are now, you're going to break a structure on momentum. You can't see it on price that says, uh-oh, we're going to start back down again. Well, there's some mega numbers on the dollar, annual momentum breakage numbers that we can define using a 10-year moving average and a 3-year moving average. You better not get back down much under 100 ever again, because you do, the floor is going to come out in a big way. And I suspect that's what maybe we're starting here, is this rollover we're seeing now from the 104. We're now got it way up in the 104s rather recently. Now we're under 104. It's a start of a rollover again. which might also be coincident with a rollover in the stock market because it's been behaving in sync. So that could help gold. But I have to caution again that yes, sometimes there's some intermediate times where you can look at gold and look at the dollar and see their inverse. But put this in your mind. If you waited on the dollar index to tell you to buy gold, okay, here's what you've got since December of 2015. Gold was at 1,050, okay, bare low. December 2015, the dollar index was around 98, okay? Since then, the dollar index right now, how many years later, okay, 2015, 2024, it's 103 something. So 3, 4, 5. It's up 5 or so percent. And it's been either side of that 98 price level, by the way, in the years since. So it's been up and down. But right now, we're only about 5% higher than we were at the end of 2015 when gold made its low. Gold is double where it was at the 2015 low. So using that correlation between the dollar and gold is not a great idea. I think it will help gold when the dollar does break, especially if it goes down another, let's say, 4 or 5%. It's really going to fall apart. At that point, it'll no doubt help gold. But it's not an essential. Gold's demonstrated that.
As the week draws to a close, gold has surged to $2,035, signaling ongoing bullish momentum, while silver tests a key resistance zone. Last week saw silver consolidate around $21.93 support, followed by a rally above $23.33 resistance. Currently, silver appears to consolidate within an inside day pattern. These developments hint at potential gains for gold and a potential breakout for silver shortly. What are your thoughts on Michael's prediction? Share your comments below. Don't forget to like this video, subscribe to the channel, and turn on post notifications for more content like this. Thank you for watching.